Robert, thanks a great deal for joining us on the show to discuss this Q2 capital importation report that was released late Thursday, early Friday morning. But let's hear from you. What's your impression of this report at AfriInvest?
Well, it shows again some of the issues that have been echoed over time. The fact that, again, if we put in perspective, why do countries require capital? Right. See, capital flows naturally will move to where the opportunities are existing, and then for us, seeing a slowdown in importation of capital from the high of $8.5 billion, which we experienced in Q1, in Q1 2019 of this year to $5.8 billion. Again, it speaks of some of the domestic issues that we are currently experiencing. Again, it's the highlight of it is the fact that we still see this dominance of foreign portfolio investment, into Nigeria, FPIs. As against getting the direct investment that will invest in our real sector, which of course is the most important aspect for this Nigerian economy to be recatalyzed on the path of growth. And again, we fear that we might not see that much of inflow into direct investment, because of so many other, issues. Security is one of it. As it's often said, the dollar can be a coward, So when there is insecurity, especially when you're bringing in funds to invest in the real sector, the real sector requires a whole lot, to bring your money to invest and set up companies here. You have to go through the process of registering your company, not just that, setting up, if it's a factory, for example, in the manufacturing space, it requires you to be involved, So if you're setting up your factory and it gets blown up, because of insecurity in the land, you lose your investment, which is why we're beginning to see more and more, appetite for foreign portfolio investment, and again, in the past, we've always experienced a situation where we see a balance of play, between equity, bonds, money market, but now we're seeing, a skew towards money market securities, and money market, because they are, short term. In fact, equities are even attracting more in terms of inflow than bonds, which are supposed to be long term, even though they still appear they are safe investment, in the sense that they are still government investment, risk free, but investors who are bringing in funds are still finding it much more comfortable, more convenient to put their funds in shorter term securities, which is why you're seeing the surge, towards foreign portfolio.
This is what we're noticing currently, now that we're neck deep in Q3. But for Q2, looks like there was lower demand for equities when you do some quarter-on-quarter comparison.
Well, you've always seen, in terms of quantum of portfolio investment into the domestic market, we've always had more in the money market space. I can say for as far back as 2 to 3 years now, if not up to 4 years. And again, it all started when we had our crisis in 2015, which dovetailed into the recession we suffered in 2016. So we are beginning to see a continuance of that, in which case investors are not willing to consider investments. Equity got only 3.8%, whereas foreign portfolio investment is hitting almost 60%, when you compare over the total capital imported, not just for FPI, but when you look at it for FPI, FPI alone is accounting for about 74 to 75%, of the total investment. And equity got only 3.8%. You're seeing other investments maybe at about 22.3% or thereabout. So what we're saying is that portfolio investment find it more convenient to invest in shorter term instruments right now. And it speaks of the risk profile of the country at large. When investors are not willing to take long-term risk, even of the same issued security that has the full backing or the full faith of government. I mean, if you buy into treasury bills or you buy OMO, OMO is backed, by the full faith of the central bank.
Yeah, so guaranteed.
Treasury bills by the federal government, and central bank is the banker to the government. So again, when you buy into bonds, even though they are long term, it's still backed by the full faith of government. So why would investors prefer shorter term instrument? One, because of the policy direction of the central bank. Again, we are seeing a situation where the central bank is targeting short-term interest rates, again, to attract foreign portfolio investment. Because when you target that short-term interest rate and foreign portfolio investment gets attracted, one, they are able to retain the capital that are already existing, which is quite huge. I mean, a quick analysis will show that we have about $16 to $17 billion, of foreign portfolio investment in our money market. I mean, we're not talking about equities and bonds in money market alone. So when you analyze that vis-a-vis the current reserves level, and the possible external shocks, that may crystallize in the next few months down the line, then you begin to get worried, as to whether we will really have the muscle to be able to shoulder these kind of shocks, which is why the central bank will be targeting higher interest rate. And you've seen the recent results on OMO auctions, which shows that for the long-dated OMO instruments, investors are willing to play much more in that space. And we are seeing the central bank even upping interest rates. Right now we're getting rates as high as 13.5%, which gives you a yield at about 14, even nearing 15%. So these are signals, that the central bank is sending to show investors that they're interested in this capital. Because let's think about it. The quantum of portfolio inflow into this economy since the launch of I&E FX window in 2017, April 2017, it's quite huge. It's not that which central bank can just, can just lose. It will have an impact on the reserves, and this will have a very dire consequence on the exchange rate, which is a core mandate for the central bank right now, to maintain. So we're likely going to see this trend continues, even though we are still seeing a sort of slowdown. I mean, we're looking at 8.5 billion in Q1, and now it's 5.8 billion, And if you look at the quantum of portfolio investment, over time, you've seen that it has stayed within 60 to 70, in some cases 75% of the total capital inflow into the system. And in short time, it helps us. At the longer term, it's not favorable for this.
The one that should have been helpful.
This is hot money, really.
Hot money.
When they're about to leave, then the crisis, comes on us.
So, but then what should be done in the short term, maybe short to medium term now, to attract FDIs? Is there anything possible?
Well, it's a long process, really.
By way of at least decision.
It's a long process. If you study the data, this trend has been on since 2010, as far as I can see the data. Since 2010, we've seen that, sort of low appetite for foreign direct investment. And think about it. Why would a business want to set up in an environment where there is so much insecurity? We're talking about, and that's why, again, when we talk about investment, security is one thing that is very key. It's very key, and it's something that the government needs to take much more seriously. There are other issues around ease of doing business, ease of doing business, cutting across how to get a business registered, I think the Office of the Vice President, did a lot in 2017 as part of the ELGP plan. I'm not sure that, one thing is to put up the policy and to say, oh, you can register your business online. How easy is it, to get this successfully done? And these are some of these issues. And that's one area. Even if you're able to register your business seamlessly, what about the power that is needed to run. There's no business that can run on power, And I mean, someone said it's quite funny though that even when God wanted to create the world, he had to say, "Let there be light" first, Then every other thing can follow, So power is one critical area of infrastructure that the government needs to focus on. That's not to say that the government is not doing anything. Government is doing a lot. We're just advocating for a process that allows some of these things to be done, in a market-reflective manner. You understand? You see, we don't have power most of the time because, we still try as much as possible to say, let's manage the tariff, because most people are poor, so we should find a way to subsidize electricity. And investments will not thrive on the basis of subsidy. When we privatized the power sector, for example, in 2013, we were expecting that, more capital will flow into the sector. But we didn't see that, again, because there's still big elephant in the room, the tariff, which is still being managed. But if you allow a cost-reflective tariff, even distribution companies will find it convenient to invest in metering, which is one issue that most consumers, talk about. So and that's just one of it. So it's a whole broad spectrum of issues that the government needs to focus on. Unfortunately, it's not something that the central bank will do alone. Some of the policies of the central bank may help, but much more importantly, from the fiscal side, we need to see positive steps that have been taken that will actually attract investment. Even in our policy communications, sometimes we have some form of inconsistency. Today we want capital so badly. Tomorrow, we are running after those who already invested in the system. And these are signals that some investors will look at and like, I can't go near that now, and then they'll find it more comfortable to deal in shorter time instruments.
Let's look into the source of these inflows. Actually, I mean, UK, we understand, contributed some 53 to 54% of the whole inflows at this point, and here we are. This is a country battling with Brexit. We've also got other issues on the global stage now, US, China, and all of that. How will all of these issues impact on Q3 reports?
Well, for us, we believe that, Brexit is an issue, it's like the global economy cannot wait for the issues about Brexit to be finally dealt with. If it should be a hard Brexit, let's just bite the bullet and move on. And it seems like every now and then the Brexit issue keeps coming up because, again, it has not been. And
South Africa is another country that also contributes. They're fourth in the category. I think some $314 million or thereabouts. With the xenophobic attacks, is anything likely to continue, or will having that as a threat?
Well, for that, that may not be a threat per se, because again, we're talking about. This is data that suggests that capital portfolio flows account for the bulk of the funds that we're getting in terms of capital imported. But even if there are foreign direct investment, if there are no issues, I think the issues we're having right now, is the case of South African investment in Nigeria and Nigerian investment in South Africa, that people are trying to identify businesses that are run or owned by South Africans here in Nigeria or by Nigerians there in South Africa, But for portfolio investment, it might not really be an issue because, again, when you bring in your fund, you buy money market instruments or you buy
those who need it will actually place a bet on it and go.
Exactly. So you can. So in as much as there are no restrictions, if there are no restrictions on capital imported from South Africa, which I don't believe there will be any reason to restrict capital from, South Africa, then that may not be an issue. And in some instances, we see situations where, some funds are coming from the US and they find their way in South Africa before they finally get into Nigeria. So it's not directly, the source is not directly.
After all, money never sleeps.
Yeah, money never sleeps.
It doesn't actually discriminate. The
Absolutely.
All right, Robert Omotunde, Head of Investment Research at AfriInvest. Thanks a great deal for your insight. I appreciate your time on the show this morning.